Good morning. Welcome to the Monday Market Update. I'm Nash Paradise, joined with me fresh off the red eye from Las Vegas or something, probably on 2 hours of sleep, Mr. Andrew Cady. How you feeling, boss?
I'm feeling surprisingly good. I'd be happier if the markets were being a little nicer, but it's just the triple whammy today.
Yeah, it's a lot of mean, and last week was a lot of mean, and it's like sitting there, playing roulette, just like, man, all I need is some red, and you just roll black, 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 black. Okay, cool. Let's go play blackjack. Hey, man, every time I get sitting here on an 11, double up. Oh no, I'm getting sixes. I'm getting fives. You just need to hit something, man. It's rough. 2 rolls, no butter, but. Let's get into what's going on here. We can break this down a little bit. Super volatility meter, things are going nuts. There's something I want to add to volatility that I'll get into a little later, because now that I've overlaid a couple of these charts together, tells a new story that I hadn't seen up until like 3 minutes ago. So I'll bust into that after we get through the data and the econ points. Anything that you'd add to last week's rates other than rough?
They were, it doesn't. You may look at this and say volatility meter high, but it's only an 8% rise in rates. But the volatility just intraday was spectacular last week. It wasn't a huge 3/8% or a 0.5% jump in rates, but there was just no consistency to last week whatsoever. It was like every morning we get hammered, and then afternoon it would be better, and there'd be a reprice for the better and a reprice for the worst, and then a second reprice for the worst. It was a week where you pretty much just wanted to buckle your seatbelt, sit back, and wait.
Yeah, and a lot of things made sense. A lot of things did not. The problem is, like, markets don't know what to react to. You've got all these stimuli coming in from all over the place. And, you think the market's going to react to this. It doesn't. You get this report, things move, and then they settle. So volatility was up, but a lot during the day, a lot just trying to figure out what's been going on. Hasn't been a lot of fun. But let's talk about the econ data that we got last week and what mattered there. And, as much fun as the middle of the week was, and we got some preliminary job stuff on Thursday, which wasn't that, important or insightful. Friday was. So I'll let you break down, what did we see on the first Friday of the month. Big jobs report came in way outside of where we thought things were going to be. What do we got here, Andrew?
Yeah, I mean, the jobs report should have rocked markets in a good way, but oil overshadowed everything. It just is what it is. But BLS, in their typical fashion, they seem to have wild reporting stats. We went from this massive increase in jobs in January, where we, had 130,000 job creations, to February's report having a negative 92,000 print, lost 92,000 jobs in the month of February. But we also saw revisions to the downside. December's final revision came in, and it was revised down by another 65,000 jobs. It went from a positive 48,000 to a negative 17. So December actually looked like a pretty good month. We came in right about expectations. No, we actually lost jobs in December. January's revision was small. It only came down 4,000 jobs, from 130,000 to 126,000. But keep in mind, January still has another revision that will come out the first Friday of next month, so long as there's not a government shutdown or something that stops these reports. But, you just never know anymore. It seems like everything is upside down. But yeah, the jobs report was probably one of the bigger misses we've seen in a long time. But oil overshadowed it. And now we have a week ago the best rates of the year. And this week we open at the worst rates of the year. So a lot can change in a very short window.
Yeah. And I think, looking at this, it's a tale of two data points. As we were in Friday and things were going and moving, oil initially crushed us and no one cared about jobs. Unemployment rate rose to 4.4%, non-farm payroll negative 92,000. But as the day went on, it did seem like markets were starting to turn a little bit. We got a lot of that back in the intraday moves. We actually got some reprices for the better as we got through the day. So, hey, moving in a good direction. Oil over the weekend just crushed all of that. So nothing good there. And oil is the big, the elephant in the room as these prices soar. They're taking the 10-year with it, but not nearly as much as I would have thought. You'd think for the pricing that we have and where we're sitting, we'd see a 10-year treasury at 425, 430 right now, and we don't. It's 415. So
Yeah.
I'll get into that in a bit because I've got
I think it's worthy of noting, for those that might not follow the crude oil market, it's worthy of noting that oil right now is up 77% since January 1st. We opened January 1st at $57 a barrel, and we're currently sitting at $101 a barrel. So we have a 76% increase. And like Nash said, surprisingly, the 10-year treasury has held on. And I think that's because of the underlying weakness. If there would have been gangbuster jobs reports on top of this, we could be in real trouble right now. But it's like Nash said, it's the tale of two different data points right now.
Yep. Let's talk about what we got going on this week. If there's anything that can help break us out of this oil bubble, Big Red is Tuesday. That's where we've got a lot of stuff. We have a ton of things coming on Friday with some important data points here, but I said Tuesday. Look, Wednesday. I can't read the little print because I guess there's nothing that we really care about on Monday, which, is fair. The only thing I've got today, consumer, inflation expectations didn't even make this list. So not worrying about that. But Wednesday, core CPI, headline CPI, for February, the projections on here show inflation pretty flat, maybe going down a bit on the month over month core. Do you have any projections on what we're expecting from CPI this week?
Well, we really didn't see the run up in oil. It started a little, but it really didn't start running up until February 27th. So we probably won't see much inflation data, if any at all, in the February report for oil. So I think we could have a tame inflation report. We also have some replacement numbers from last year that are going to be pretty large. If you understand how these year over year numbers work, February's numbers from this year replaced February's numbers from last year. And February's numbers of last year are actually a pretty decent sized number. So I think we could have a decent CPI report. Might be a completely different story as we walk into March's CPI with the run up in oil. So, buckle your seatbelts, folks. It's going to be a long ride.
Yeah, I can tell you as I got fuel this morning, I'm on diesel because I'm in Texas, and that's what you do. You basically pop out of the womb with keys to a diesel truck. 4.30 a gallon for diesel was not a ton of fun. I hadn't really noticed all the changes. You don't really look. I don't look at gas prices as I'm driving unless I need fuel. And when I looked at that, I was like, okay, this is a significant uptick. So yeah, the March, month over month, year over year as we get there, could be really interesting just based on the timing of all this. We do have some jobs data coming in on Thursday, nothing that we put nearly as high as the BLS data that we got last Friday. And then more inflation data on Friday. Lots of data on Friday, but Friday is a good one for PCE. The Fed likes PCE. Everyone likes PCE. PCE is cool. We also have JOLTS. So it's a lot of data this week. A lot of things are set to be pretty flat. And I feel like everyone knows that the recent, increase in oil, which flows down and trickles into a bunch of other, goods, shoot, oil makes everything. There's a lot of stuff in manufacturing that comes from oil. Oil prices being high mess up shipping. It messes with a lot, and it doesn't take a long time for that to catch up to the rest of our national and world economy. But it just means that the data we're getting right now, I feel like investors are going to look at that with kind of a meh attitude because it's not really hitting yet. Any disagreement there?
I have no disagreement there.
That's unfortunate. That makes for a bad podcast. Let's.
I don't have a disagreement on it. I agree. I think the call it fear, the anticipation of what March's CPI and PCE look like will put investors to kind of not care about this one. They're going to, in my opinion, dismiss it because all eyes will be on March.
Yep, 100%. All right, let's move on. Still no one cares. We have
well said. Still
Sorry.
No one cares.
Like,
we're seeing the third rate thing just about disappear on us.
Yeah, kicking the can down the road. Right now we've already kicked it from June to July on this chart, and we've kicked it from September all the way down to December, and even then it's kind of dicey. We were seeing a little bit more support for that, 275 to 300 in the future. Now, not so much. It looks like with everything coming on inflation the way it is, like higher for longer, hold for longer. But like pushing out that first rate cut, I didn't think it was going to be an interesting year. It was pretty well forecasted, 2 cuts. But what we didn't forecast was, war, and we didn't forecast oil flying. So that's why long-term forecasts, they just don't matter that much. Everything changes. And I just don't think average consumer cares much about the Fed funds rate right now, knowing full well how much impact everything else has. I'm not seeing this as being any kind of saving grace on rates, affordability, et cetera. 2-quarter movements is just not going to do it.
Agreed. I think if this war doesn't resolve itself quickly and oil come back down, this could actually put a big hamper on the spring buying season. And, we were actually set up for a gangbusters year. Everything was turning and looking really, really good. And I think we need this conflict, obviously, for the loss of life, for everything that goes with it to resolve quickly, but also to help our markets get back in line. If this would become a prolonged conflict, we could see quite the year.
Yeah, prolonged, like 20 years in Afghanistan sort of thing. Yeah, it's not hard with as big as Iran is to look at this and be like, okay, this could be a while. The 4 to 6 week estimate, I'm not sure a lot of people are confident in that. Who knows? When you get involved in something like this, we don't really know what it's going to look like until it looks like it, and the markets are going to be scared. They're going to expect trepidation from investors. We're going to see money, being pulled out, thrown into things like gold and silver. The flight to safety on 10-year Treasury bonds, which usually make any kind of international conflict good for interest rates, doesn't even exist right now. It's not there at all, and because of that, we just got to kind of ride this wave. So let's look at the wave and see where rates have been going here. Yeah, a lot of the same. You see that down and up, down and up. I feel like this chart's just a little behind right now. We're only 9:44 a.m. on Monday, Central Time. And so most lenders have just opened up pricing in the last 10, 15 minutes. A lot of them are probably holding out, waiting to see, what's going to go on with the rest of the day. So this spike is consistent right now. I have a feeling that we're going to get some revised information on this. It's going to show closer to 620. I don't think we're actually at 614 right now, not with the loss in the different MBS securities.
Yeah, and I think it's worthy of noting where we're kind of at in markets. Right now, we're floating on this 99.6 line for the 5% coupon or 5.5? 5% coupon. We're at a 99.6 on the 5% coupon. We have been flirting with this line all day. If we significantly drop below it, we could see 60 basis points run off before we hit support at a 99. Mm-hmm. This could be a runaway train on us. So if you're a loan originator floating loans, you need to be very, very careful with it today. The 10-year Treasury is also battling right now with Fibonacci level at 415.5. Even if we crack 415.5, we need to stay under 420 to 421. If we go above that, we'll see 433 on the 10-year treasury, and we really are going to be in trouble.
Yeah, I'm putting my ceiling at 419. I don't want to see 420s. You get to that 4.2, and that's so rough on 10-year treasury yields. And to answer Joe's question here in the chat, oil prices drops. Do you think it may change the cuts? It could. The cuts can go back to being data dependent, but how long does oil stay high? How does that affect inflation going forward? Every single day with oil over $100 a barrel is going to have a direct impact on trucking, manufacturing, cost of goods. Like, it's going to have a trickle down effect that'll last for a while. And to Andrew's point, if it's short and sweet, in and out, and then back to normal market levels, then we will recover from that pretty quickly. If not, then this could hold for a while. Inflation numbers could be pretty rough for a while. And if inflation is on the high side, you can't just start with rate cuts. You're worried about making things worse. But look at the jobs report. We're getting opposite conflicting data here, and so it's really setting up for an interesting summer where inflation is likely to go up from a lot of these things. But we've already got jobs reports showing massive revisions down, showing negative 92,000 jobs added. So is the Fed gonna lower to try to spurn employment? I think they feel like employment's more important than inflation right now, or at least it has been for the last 6 to 9 months. Not if oil prices start to send inflation in the wrong direction. What's your take on that?
I would agree. I know I'm not making for a colorful commentary arguing with you today, but for the first time in a long time, Nash and I are just in agreement. It's all going to come down to timing on this, how quickly this resolves. Like, if this is a short blip in the radar, it's not going to impact long-term inflation too heavily. But I mean, keep in mind, the majority of the goods we get in America are shipped in from overseas, and the cost of oil to ship everything in is going to bleed into pricing everywhere. So we could see a really, really, really rough setup over the summer for inflation. And if you have inflation, it's going to kill the rate cuts. However, if the job market continues to crack, which also could be another result of this, where you could really start to see employers taper back, we could find ourselves in the tale of two markets right now.
Yeah. So speaking of a tale of two markets, what I wanted to highlight, I think we're done with this slide, is looking at the 10-year treasury, and I've overlaid it with the UMBS Security 5.0. And this is kind of intense, ultra nerd stuff here. But we know that the 10-year treasury bonds and the mortgage-backed securities pricing tend to move, together. As the 10-year yield drops, mortgage-backed security pricing gets better, rates get better. Neat. Looking at, and what I was thinking was, I was looking at things, I was like, man, 415, 416 on the 10-year, it feels lower than what we're seeing on the bond yields, mortgage-backed security yields. And the data supports that. Just looking at like February 11th, about a month ago, we were sitting at this 417 mark on the 10-year treasury. But the mortgage-backed securities 5.0, we're hovering right around 99.97. So we're, almost 40 basis points removed at the same 10-year yield on the MBS. And the weird thing is, like, before we had mentioned how, those numbers had shrunk, that we had gotten closer and closer together, that mortgage-backed securities yields were getting better despite 10-year yields not changing a whole lot, which is, good for originators, good for real estate. That tightening between those, the elimination of that spread, was largely due to, stability. The lack of, wild things changing in the market. And I think what we're seeing right now is, due to volatility, we are increasing that spread. Mortgage-backed security yields are moving much more severely than the 10-year yield is, which doesn't spell good things for eventual mortgage rates, but it's 35, 40 basis points difference at a lot of these levels. It's kind of shocking. I hadn't seen that until this morning when I was just thinking about it. Is that something that you've picked up on, or do you have any thoughts on that volatility spread?
The volatility spread is there. I was looking at the chart this morning. Yeah. We've seen this compression where, the yield has come down and it's coming back up. My only kind of thought on it is, obviously housing is on the mind of this administration, maybe not so much since we're currently in a wartime. However, I do know that housing's on the mind of the administration, and this run up in mortgage rates might be the thing that actually spurs the move forward of Fannie Mae and Freddie Mac buying MBS securities. We've talked about it. They've raised the cap not to the 200 billion but to 450 billion, and maybe this will be the thing that actually says, hey, we need to actually make this purchase happen, which could kind of offset some of the negative we're seeing. I think all options are on the table right now.
Yeah, I think the news cycle needs to catch up. I think we need to get some reporting where it shows, hey, mortgage rates have increased, 0.25%, the kind of stuff that drives, that you're going to find on Yahoo. That's not just us Yahoos talking about this on a real estate podcast, but the things that happen because of the things that we're talking about, where it actually makes national news, where it does put some pressure on the administration to deal with the consequences of, how does this conflict in Iran impact the things that are top level goals? Affordability is a high one. Housing affordability is huge as we're getting into midterms. These are going to be major talking points. And I agree with you. I would, expect to see some sort of, activity happening, something to try to stop that bleed once we get levels high enough that it makes the news cycle. It should be, because we're there. I've been looking at this cliff that we fell off of in the last week and a half. But when does it update? When do people see things? Like, do people care that we're at 614 instead of 599? No, not really. You get up to 623, 624, and we get close to a full 0.25% increase. I think that's when it makes the news. I think that's when it gets a little bit more attention. And maybe investors pay attention to the fact that the jobs report was trash. Who knows? That could just be wishful thinking, but it's something to keep our eyes on as we look forward. Anything to close us out?
That's it, man. Let's go out. Let's buckle our seatbelts this week, because it might be another high volatility week. Probably.
Yeah. Lock it if you like it. There's enough data, but the data is not necessarily going to matter. It didn't matter last week. So, take what you can get, help people where they are, and, tune in next week as we continue to digest and process this and figure out what to do to be in the best position possible.
Take care, guys.
All right. Have a good one.